Now that is one scary chart. If you look at charts and you get scared or you think this is super complicated, I have no idea what I'm looking at, this video is for you. I have three main things that I want to accomplish in this video. Number one, make charts less scary. Number two, make charts easy to extract data visually so we can look at them, see them, and then use that and do something about it. And then three, understand the components that make up a chart. Now, everyone's going to have a different approach. There's tons of ways. There's really unlimited ways to customize your own charts. But I want to give you a really good foundational understanding of what goes into a chart, what you may want to utilize, what certain things do, what they show you, and then how you can implement that in your own charts and on your own time. And if you stick around to the end, I am going to be doing a complete random chart analysis where I'm going to randomly generate a chart live, and I'm going to start from scratch, and we're going to do our own analysis here live in the video. So you can just see kind of how at least my brain works and how maybe you can take bits and pieces of that and utilize that in your own analysis. There is no right way. I should start there. There is no right way, and there is no perfect way to chart a stock, to chart an asset, to chart anything. There are infinite ways to do it. The right way is the way that's going to give you the data that you need to utilize in a way that will help benefit you, whether you're an investor or a trader, scalper, swing trader. It doesn't matter. Think of a chart as just a fully customizable tool that you can add to your tool belt. Okay, so the elephant in the room is that I am making this video at a very interesting time in terms of what's going on in the market. When you see this video, things will, hopefully the dust has settled. I have no idea what the market's going to do next, but hopefully the dust has settled. However, what we have going on right now can be scary. Things might not make sense. You might not know what to do, and that's totally okay. That's going to happen at times. It doesn't happen a ton of times, but it's going to happen, especially if you're someone who is going to be around for the long term here. You're going to see situations like this pop up at some point in your trading or investing career. So what I'm going to do now is I'm going to get rid of a bunch of things on my chart and keep it very simple. And the first thing that I want to dive into in terms of how to read a chart effectively is going to be the type of chart that we're using. Now, I am using TradingView. I will leave a link to TradingView below this video. This is where I do all of my charting, but you can do this on your brokerage platform. Many of the brokers out there will offer everything that I'm going to talk about in this video, so you can do your analysis wherever you feel most comfortable. That's kind of a big part, and for me, TradingView feels the most comfortable. It gives me all the tools I could possibly need, and then it lets me go and customize things just so that I get exactly what I want and I can see things the way that I like and not how somebody else would like. Okay, so first things first, we got to talk about the types of charts we can look at. If you're coming from more of a CNBC background, you might be more familiar with charts that look like this. This is called a line chart. All we see is price action over time, and really all of these lines are indicated by different points. And because I'm looking at a certain time frame, at the end of that time frame, we have a point on the chart. And that point represents where the price closed on that specific time frame or of that time frame. And then all we do is just connect those dots. That's how a line chart is created. Just connect the dots. Simple as that. I like to use a candlestick chart because with a candlestick chart, which you might be more familiar with especially if you've seen more people in the trading community, you might think it's more advanced. It doesn't have to be more advanced. It's just what people tend to utilize because they can dissect more information from the chart. So these are the two most common, but if I was to go over here on TradingView, there's so many more options, and by no means is there one that's right versus wrong. Really, it comes down to whatever you like the most. Now, there are different variations of line charts and area charts, and then there's different variations of candlestick charts. There's much more where it gets more advanced, but in a nutshell, these are the most two common charts, and I would say this is probably the most common chart you're going to see, the candlestick chart, because you can extract a lot of data at a glance, which is really what we're trying to do. We're trying to come in here, see the charts, and within a couple of seconds, couple of minutes, depending on our analysis we're trying to do, get as much information as we can so we can go and use that. That's really the whole point. So on a candlestick chart, there's red candles, there's green candles. Red candles mean the open was higher than the close, and the green candle means that the open was lower than the close, meaning that price moved up during the time frame that we are looking at or during that candlestick, okay? In this case, these are one-day candles, which, by the way, up on the top, I can customize my time frames, 5 minutes, 1 hour, 4 hour, daily, weekly, monthly, which just changes the amount of time to create one candle. So daily, meaning on the S&P 500 ETF SPY, at the end of the day, at 4 p.m. Eastern time, it closes and then the candle is done. We've got a candle, it's done. And the next day it opens at 9 a.m. Eastern or 9:30 a.m. Eastern. And then from 9:30 Eastern to 4 p.m. Eastern, we have a candle. After that, it's done. The candle is formed. It's not going to change. It's done. If we are looking at a candlestick before the close of the time frame, then it's going to keep changing and it's not set in stone just yet. So on a green candle, green means up, red means down, but doesn't necessarily mean that it was down on the day compared to the prior day. It just means that on that specific candle, it was up or down. So if you look at this green candle right here, which is today, and this is a kind of a scary time to look at this, I understand, but it's a good example because the candles are bigger, so it makes it easier for us. We had the market open at this point at 9:30 a.m. at the bottom of the green candle. It was up and it closed at the top of the green candle, and that was at 9:30 a.m. to 4 p.m. Eastern time. Now this upper wick, this big green little wick right here, and then the smaller one at the bottom, that just tells you that price traded down at the bottom of that wick and then up at the top of that wick into these price zones, but it didn't close there by the end of the candle, by the end of the time frame, which in this case, by the end of the day at 4 p.m. Eastern time. And then a red candle. So for example, this one right here, we opened at the top of the candle and we closed at the bottom, indicated red, meaning price moved down from the open to the close of the candle. And then we didn't really have it. We actually closed at the low of the day, meaning that there was no lower wick. We had a small upper wick, meaning that price traded up a tiny bit at one point during the day, but then it flushed down and it closed towards the low or at the low of the day by the end of it all. That in a nutshell is candlesticks. You can make it more complicated by going to hollow candles, looking at bar charts, but this is the simplistic version of candlesticks. Most people are going to use this, especially if you're really diving deeper into kind of like more of the advanced trading community. You'll see this a lot more. It's going to be more common. That's how you can look at it. And now it just comes down to reps, seeing it, understanding it, watching price, seeing how price moves, seeing the candles play out. Go to a 5-minute chart and just watch it for a couple hours. You can go into something like TradingView. You can even go into bar replay, which is an option where you can replay, for example, today's price action. Watch this. I can replay today's price action at any speed that I would like. And as this thing plays out, I can just watch how candles develop. I can see how they form. I can see all this stuff if I want to. Now, this is not going to be perfect, not going to look the exact same as it does live, but you can still get a good sense. If you don't have time to do this live, you're at work or whatnot, it's not a bad route. So that in a sense is a cool feature of TradingView. But if you want to get more reps, again, just go on the 5-minute, go on the 1-minute chart, just watch candlesticks and check things out for a couple hours or even a couple of minutes a day. And then you'll get a really good feel for how this stuff looks, how it moves. And then you'll start to understand, okay, open, close, upper wick, lower wick. Oh, that was a crazy move. That was this. And then you'll have a really good feel. While I'm talking about this, see how we have now shown up on the 5 right here after the comma. So on TradingView, what I have is I have on the settings of my chart, I have a watermark selected. Some people don't like the watermark. Some people do. I do because, to be honest, when I'm making videos like this, we can all see what we're looking at. If I was not making a video, maybe I wouldn't need it because up in the top left, I can see the symbol. And if I open up this right here, I can see the symbol on the right. I mean, it's cool, but this is not a TradingView tutorial. I just like that we can see what we're looking at. But this 5 represents a 5-minute time frame, meaning that each of the candlesticks on the chart are 5 minutes. If I go to a 1 hour, see that we have the 1 hour now, meaning each of the candlesticks now are 1 hour. And we were showing you before a 1 day. This can be really broadened out to weekly, monthly. You can even look at yearly time frames. You can go to a 1 minute, you can go to a 2 minute, you can go to a couple seconds. Different platforms or brokers like TradingView and other brokers, they may not allow certain things, or you may have to pay on TradingView to go down to like the second time frame, a couple seconds per candlestick, but it does exist. And on very, very highly or heavily traded stocks or futures contracts, it could be, you can get some value out of that because there's a lot of volume all the time. On more thinly traded things, stocks and maybe option contracts or things like that don't have a lot of volume, a lot of trading every 2 seconds or every second, those might not be very helpful for you. Now, real quick, before we dive into the next component of charts, I do want to thank the sponsor of today's video, Iron Beam.
Welcome to Iron Beam, the future of futures trading. With our cutting-edge chart trading feature and 300+ indicators, you can now trade directly off the chart anytime, anywhere. Delivering seamless trading across all platforms, the Iron Beam journey is supported by 24-hour trader support, low day trade margins, and no account minimums. Iron Beam brings the future into the present. Join now and augment your trading experience.
So now the combination of candlesticks and the combination of time frames now gets us into kind of this reading price action. And so we can clearly see that over time, on the right-hand side, by the way, this is our price scale. And over time, on the bottom right here, is our time scale. So we have the weeks, months, or I guess now the months. This is now on a daily time frame, the months. And if I was to go to a 5-minute chart, you'll see this is actually more so in the hours of the day on the bottom of the time scale. And we're now, the point that we're at here is now we can start reading price action. We can start getting a sense. Okay, this is a 5-minute chart. Here's the price scale. Here's the range that we saw during this span of time. Here's how long it took for this to happen. This was a very volatile day. This was a day we don't see very often. From the low of the day on SPY to the high of the day, there was some news going around, so that does play a role. That was an 8.59 or 8.6 roughly % move. That's not, I'm going to be honest, that's not very common. So the more reps you get, the more you see these charts, the more you'll be like, whoa, that's not normal. That's an outlier. We don't see that normally, because you'll go through days where price will, compared to this, price will just go like this. You know, maybe it trends a little bit in a direction, but it doesn't move. Like the range is tight. Now the range is huge because we've got a lot of news going on and there's a lot of crazy stuff going on in the world. So the market's reacting in a manner, maybe positive, negative. It's like all over the place. But the way we can frame this and be comfortable with this is that the more reps we get, the more we see this stuff. And, you know, looking at examples like this, it's not as scary, because in the moment when we're watching these candlesticks develop, I mean, this is like, oh my gosh, we're not going up. We're going straight up. We're going straight down. What's going on? It could be very easy to get caught up in the FOMO and get caught up in the hype around this stuff, and then make decisions that maybe you didn't mean to make. The next component to the chart that I want to pull up is volume. So I'm going to pull up volume now, and that's on the bottom of our screen. Now you can actually put this up on in different ways. I'll show you more of an advanced way towards the end of the video in our example on what I can do with volume. But at the bottom of our screen right now, I can look at volume, and with these volume bars, they're going to be color-coded based on the candlestick. So based on whatever color the candlestick was, the volume bar is also going to have that same color. It doesn't mean that the volume was, you know, down. We were down, up. The market's going to go down or up. That's all that it means. It just means that the candle was red or the candle was green on that time frame, and the volume will correspond. Just makes it easier for us to see. So when we're looking at this specific candle, we don't get confused. Oh, what volume bar was that? No, we can see pretty clearly, okay, it was a green candle, means it was a green volume bar. If I hover over it, I can see. Now, if I hover over, I'm actually able to see at the top of our screen right here. See how it says VOL? That tells me how much volume during that candlestick that we have. If I was to hover over a specific candle, the highest or the most volume of the day, 2.05 million shares of SPY were traded on that 5-minute span of time, which is crazy. But that's what that's telling me. Something to think about for volume: when there is news, we tend to see volume spikes. So if there are big financial catalysts, big pieces of financial news that are coming out, it could be in the pre-market hours, could be in the after hours, could be during the day, that will signal, or that is generally going to be shown by a volume spike, because people are making decisions based off of that news. Something to always be aware of, or always know that, okay, there could be news, or if there is news, or if there was a volume spike, can I relate that to news? If I can't relate that to specific news, maybe that was just a result of price action and price breaking or breaking down or breaking out over a certain level, and I can use that in my analysis, which we'll talk more about here as the video progresses. These two different shades, by the way, on TradingView, I have color-coded them in my own respects, the way that I like them, but this is showing us the after hours, this shading is showing us the pre-market hours, and then this shading is showing us the regular trading hours. How do I know? Well, I can look at the time scale on the bottom of our screen. 4 a.m., we have pre-market hours trading beginning on the East Coast, and that goes until about 9:30 when the market opens. Then from 9:30 until 4 p.m., we have regular trading hours, and then the after hours opens, which we're currently in the after hours as I'm filming this video, but it's only 21 minutes in. We really just begun the after hours. All right, now let's zoom it back out to the big picture, the 1 day time frame, meaning that all of these candlesticks are 1 day. Let's talk about analyzing price, because we now see volume, we see price, we see candlesticks. We got a good sense of time frames. Let's talk about analyzing price. How do we do that? How do we see things? Well, I think it's fairly straightforward that we can identify like a trend to the upside, or a trend to the upside in this period. And then you can say, okay, well, you have a trend to the downside this period. And as you zoom in, you can find millions of trends inside of trends, and you'll have people out there telling you that your trend lines don't mean anything because I can always create a new trend line that completely invalidates your trend line. And that's absolutely true. Like that could happen, like absolutely can happen all the time. The biggest thing that I want to talk about is that you can look at different periods, and when you notice these different periods, there's a couple of different things. You'll get periods where price action doesn't really have a direction, and that would be a period of consolidation. This would be a good example of a period of consolidation. There's even one up here, pretty clean, right? A couple of days or a couple of weeks where price action clearly did not move up or down. It was just flatlining. It was bouncing around within a tight range, and that's a period of consolidation. And then you'll have periods where you can see that price is clearly trending. So for example, in this span right here, price is clearly trending to the upside. We've got higher lows, higher highs. The bottom of the candlesticks continue to kind of stair step up. The top of the candlesticks keep going higher and higher and higher, and that's a trend to the upside. The trend to the downside is quite literally the opposite. We have a series of candlesticks where we go lower, lower, lower. The bottom of the candles are going lower, 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 and the top of the candles are also going lower, lower, lower. We've got lower highs, lower lows, clearly a trend to the downside. It doesn't need to be as complicated as people make it with all these lines. You can draw your lines however you would like. We have other videos on the channel diving deeper into identifying trend lines and different patterns and stuff. But in a nutshell, we are able to identify a series of lower lows, a series of lower highs that would indicate a downtrend, and the vice versa on the upside. But what I want to get to next is something that I think is very important to talk about as well, and that's something called key levels. And this is really, I don't want to say it's an abstract concept, because in a sense it could be to some, and the way you phrase it really could make it as easy or as hard to understand as possible. But the part that I think gets people caught up is there is no right way. There is no, oh, this is a key level because, or you must use like my key level should be the same as yours. No, it's not. Like, I'm going to see things differently than you. But the way that I like to look at key levels, and the way that I think many people will look at them, is they're a level where we either had a big reaction or we anticipate a big reaction, to keep it simple. And we could be wrong in our analysis, or we can be totally wrong by that, by the way. But they're levels where we can either anticipate a big reaction or have already seen one. How do we know what's a big reaction? Well, to be honest, it is up to you and your own definition. But one of those things would be a series or a period of time on the chart where we have a higher area of volume and a big move. So what we're looking at right now as we are developing, look at how high this volume is on the right here. Like, that's very high volume, and we're seeing a huge move. So as time goes on, whatever amounts, like whatever low we put in here, whatever high we have here, this is going to be like a key level looking back. Now, we're in the middle of developing it right now, so I don't know exactly what that's going to look like, but we're developing one right now. But the bigger one on the chart, we can see back in the middle, back in August of 2024, that's a key level. We had a big dive to the downside, high volume, and then a big bounce. What we could do is we can mark off the low of that area, and that's a key level. Now, it just so happens that we blasted right through that here with some substantial news, and so it didn't really matter that much. That key level was kind of irrelevant. We didn't have a big reaction where price came to it and then bounced massively. It didn't really matter. But there are other periods in time, other times where we have key levels on the chart, and price will respect them differently. We can also look at key levels as prior all-time highs or prior highs on the chart. So for example, on the S&P 500 right here, this is the all-time high. This is an area that we can look at and say, okay, if we come back up to here at some point in the future, that's a key level. If we break that, boom, that's a new all-time high. It's on a lot of people's minds. And now we're breaking out. We're but back in bull market territory. Like, that's a big deal. If we look at something, for example, a great example of this, I think, is on IWM. This is the Russell 2000 ETF. If I zoom out to this one and take a peek at it, let me look at this. We had a prior all-time high that I marked off here back in 2021, which we have not reached until 2024. We hit that exact spot and then immediately rolled over. And not only did we roll over, but that area has now held up as a very strong key level because the market dropped like 30% off of that high, which is kind of crazy in a couple of months. So that rejection is showing us that key level absolutely matters. One more example on the S&P, we had this high back in 2021, which we got close to, and we struggled to break it. We couldn't get above that right here. We had a consolidation back here. And then we finally broke above that. The S&P had a very strong move to the upside. So that key level, once finally broken, once finally, not respected anymore, now provided the opportunity for a large move. And so think of key levels as prior all-time highs, prior lows, prior bounce points on high volume, prior rejection points on high volume. These are all key levels. And again, what key levels you like to look at really come down to what you think is most important. The next thing to talk about when it comes to charts is indicators. So up on TradingView, I can pull up a bunch of indicators. I have favorited a couple of things that I thought were cool. But I think what the most important part here about indicators is finding the ones that you like the most. I am not going to come on here and tell you that you must use indicators. There's a couple of common indicators people like to use, and one of those would be the VWAP, the volume weighted average price. So if I pull this up right now on the screen, let me pull up the VWAP, the volume weighted average price. If I go down to a 5-minute time frame on this, you'll see that I can have the VWAP on my charts. Now, this has got the upper bound, the lower bound, and the middle bound. Many people will like to customize that. Like, for example, I'll go in here really quickly and show you what I mean by that. I'm going to get rid of all these upper bounds and fills and stuff and just use the regular VWAP, and I'll make this line a bit thicker so you can see it a bit better. And that line is going to show you the volume weighted average price. It's a very common indicator people like to use. Does it necessarily mean that it has to respect this? No, but people like to use that as it's kind of the average. Based off of volume, it is the average based on what we're seeing right now. And so there'll be periods where you generally have some respect of that VWAP. So for example, this last Friday was pretty good respect, meaning it didn't go above it once it got below. And then today, you have a period where we just kind of hang around, bounced above, below, above, below. And then this afternoon, it actually held above, showing some strength into the end of the day. I mean, this is an indicator people like to use. There are a million indicators out there that all can help, but the biggest thing that I want to make sure we are talking about when it comes to indicators is not adding too many to your chart. It is one of the biggest mistakes by far. It's adding too many indicators to your charts, because then what you're going to have is a situation, for example, if I start adding all these things, I got these SMAs, I got these EMAs, I got these gap indicators, I got all these indicators now. What does this mean for me? What is going on? If I can't utilize this in a manner to determine what's going on, and it's going to confuse me more, it's not worth it. Trust me, it's not worth it. You don't need all this stuff. I would recommend that you experiment one indicator at a time, and then as you go, you start to say, okay, this is helpful for me. I like it. I'm going to keep it. I'm going to add one more. Is this helpful for me? Not really. All right, I'm going to get rid of it. For me, I don't use any of those indicators. I actually use one that's called the visible range volume profile. I'll jump out to a bigger time frame so you can see it better. All this is doing is it's kind of flipping this volume chart on its head. And what it's doing is it's showing you where the highest areas of volume were, but at what price. So on the right-hand side, we've got our price scale. And where these bigger volume bars stick out, that tells me, based on the time frame I'm looking at on my chart, that price or those prices or that range of price is where the most volume has been traded. These are areas that I like to use as key levels. So I use something like the volume weighted average price to help determine key levels and to help determine where I think price could go if a key level was respected or if a key level breaks down or we break out of one. That's what I personally like to use, but it's just a different way to look at volume and look at price action in a clean fashion. So I have my volume on the bottom, I got my volume on the right, and then from there, I do all my other analysis. I do my charting. I make my trends. I draw my trend lines. I draw in my key levels, my support resistance lines that I think are important to me. And then I let the charts play out from there, and I use that how I see fit. I was going to talk about price action patterns in this video, but I have some older videos that I do talk about different bullish and bearish patterns. I don't think it's that important to get into some of the weeds of some of these different chart patterns in terms of reading a chart effectively. Like, you don't need that to read a chart effectively. That's where you can kind of get creative and start to see things and then build out your own strategies by utilizing some sort of patterns that, again, are really subjective because it depends upon how you see them and everyone's going to see things a bit differently. But I do want to touch on a couple other mistakes. We talked about too many things in our charts when it comes to indicators. I think that's a great example. But the other piece to talk about is news. Understanding that we can't control the news. I use this MarketWatch US economic calendar site so I can get a sense of what the biggest pieces of news are coming out this week or whenever I'm looking at the charts, just so I have an understanding of what's going on. If we know that there is high impact news or there is news that tends to move the markets, and as time goes on, you'll start to understand what news is more important than other news in terms of markets. And we do go through cycles where certain news was important, now it's not, and now this news is important, and now it's not. Like, that happens all the time. You can't control that. Charts are cool, but when, for example, the president decides to, announce tariffs and we have this massive move to the downside, you can't control what's going to happen there. It can be pulled back, it can be doubled down. There's so much that can happen that you cannot control. So as much as, your chart, your key level, all your analysis, you think makes you have a better feel for what's going to happen next, you do not. And so you have to always make sure you're aware and that, you let the news almost humble you at some point, because you can't control it. And as long as you can't control it, then really, you're at the mercy of the market. And so you got to put yourself in a position to where that can't destroy you and that can't hurt you too much. And that comes down to risk management, which we've got a bunch of videos here on the channel diving deeper into. Building off of that, another mistake is thinking that the market is all about charts and technical analysis. It is not. The market is much more dynamic, and charts are obviously a component. There are algorithms, there are things and that read headlines, and then algos do certain things. And there's algorithms that trade automatically for the majority of the markets, which has been going on for a while, and even more so going forward. That's how things work, but there's also fundamental value. There's things like earnings reports. There's things like fundamentals of the economy of individual companies. There's so much more that goes into it, and it's not only just about charts. So while yes, charts are cool, understand that your chart might not mean shit to a lot of other people. All right, so now I'm going to pick a random stock, and we're going to do our own analysis on that stock. FNCL. Let us pull up FNCL here on TradingView. Cool. Nothing super crazy. It is kind of playing, at least as of late, with the overall stock market to a degree. But first things first, I'm going to look at this chart and I'm going to say, okay, how do I get a sense of this? Well, I'm going to see, okay, we got a very strong trend to the upside. And this is on the 1-day time frame. So we're looking bigger picture. This is going back a couple of years now. Back here is 2023. And then right here is early to now almost you almost say we're getting closer to mid 2025. So a couple of years of time on this chart. But what I see is that we have a clear uptrend. So from the back to the left side of the chart here, okay, we were trading down here, now we're trading up here. Even though we have had recent weakness, yes, we are still, generally speaking, trending to the upside on this. We had a very strong period of uptrend in here, followed by an area really of just a consolidation for a couple of months here, and now clearly more in a downtrend as of late on higher volume. We have had some of these volume spikes that were popping off, cool. But as of late, the average volume showing up at the bottom here is substantially higher, really ever since we got into November of 2024 and beyond. It was a lot lower prior to that period of time. Okay, cool. So I'm seeing that. I'm getting a sense. Do I want to add any indicators? I mean, if you really want to, for example, maybe you want to add a simple moving average, which is this, in this case, this simple moving average. I'll pop up on the screen. This is, I should tell you right now really quick, this is the 200 period simple moving average. Many people or investors will utilize a simple moving average like a 50 or a 200 to give you a sense of how price has been trending. And for the longest time, we were above that, showing very good strength. We finally fell below that, and now we're underneath that, indicating weakness, which is apparent based on price action as of late. Does this give me any clues for what's going to happen going forward? Personally, I don't think so. It's just telling me what's kind of already happened. So I don't need that. Okay, volume profile. As I zoom this out, what I'm noticing is down here in the volume profile, down around $49 to $50, very strong area where we call a volume node. So this is an area, if we were to come down to, I would be very curious to see if we had a bounce or a reaction at that point. So that's a key level in my book. Going forward, there are some smaller volume nodes. So far, this one's holding up at around $58 or so. We came down to that area, 58.50s, 58.60s, and we bounced off that. So right now, our volume node of interest that is holding would be this guy right here. So that's an area we can draw and mark off on our charts as a key level as well. Going further to the upside, we obviously can mark off the all-time high, which is up here at around 74.35, give or take. And so that'll be my key level to watch going forward. Outside of that, I do have a couple other zones of interest. There's a gap, a very glaring gap on the chart, which will be right in here, where we had price action overnight move down substantially. So if we're looking for a move back to the upside, I'll be watching to see if that gap was to fill. And that is a key level of interest for me. If we do have a push back to the upside and the market was to rebound, I'd be curious to see if it reacts in that $65 range. So obviously we are trending down as of late, but I'm looking at this in between two bounds. I'm saying this is my first zone or one of my zones of interest. This is another one of my zones of interest. We're kind of right in the middle. I want to see what happens if we get back up into any of these zones or back down in these zones. And if we were to break through those zones, and then I'll reassess price action at that time. So am I bullish or bearish? Nothing. I'm neither. This is something that to me does not fit my strategy. I would not trade this. It's in between those two zones I was talking about. So I wouldn't do anything. That doesn't mean that you wouldn't. I would not do anything in this situation based off my trading strategy from an investing standpoint. If I'm looking at this from an investor standpoint and I'm saying, hey, this has been a pretty solid, trender for the past couple of years. If I have a couple extra dollars to dollar cost average, probably not a bad idea because we are down nicely off the highs. Let's see, we're down approximately from where we were. We're down about 17. The lowest of the day was around 21. So it's down nicely. It's a better discount than it was. Obviously, you're getting a discount compared to a couple months ago on this specific stock. So that's how I do my analysis. And then I'll pretty much do that in a quick fashion, really for a bunch of stocks. And one last thing I guess I can mention would be today's price action. We had a very big move down early, followed by a move back up. That lower wick tells me that buyers stepped in. We had some panic. Buyers stepped in. We also had some sellers to the upside today too. That's not giving me much. It's giving me a lot of, conflicting data. Nothing really crazy to talk about there. So I'll do that for a bunch of stocks. I'll add ones that fit my strategy to my list. I'll utilize that, and then I'll make my my trades if I need to from there. But that's what I do. If you're looking for a video diving deeper into understanding the different types of candlesticks and how they could benefit you, I will leave one up on the screen right now. Otherwise, thanks so much for watching, guys. I'll see you in the next video. Peace.